Hi, today we're talking about tax deferral, what it is and what you need to know. So first of all, we'll talk about what does it mean, what doesn't it mean, what is not a tax deferral. We're going to cover the two questions you need to ask yourself to figure out if using a tax deferral strategy is right for you. And then at the end, we're going to talk about the biggest omission that is happening out there that you need to know about. So who am I? I'm Julie Kranitz. I'm a certified financial planner. I have a Bachelor of Commerce from McGill University, and I'm the president at Wealth Maximization Group. We give the best information on finance, retirement planning, and how to maximize and protect your income as you grow it and during retirement. So we practice and we teach people how to maximize their wealth so they can maximize their life. So here's the thing. Today we're talking about tax deferral. So what does it mean? Well, it means that you're not paying now, but it means you're going to pay it later. So, paying it later. That's the tax man, because, you know, if you're not paying it today, you're still going to pay it later when the tax man shows up. So here's the thing, you know, tax deferral is a really nice term. We kind of give nice terms to things that we want to not deal with. So, you know, let's say I had my favorite box of chocolates and I want to eat these chocolates. So I say, you know, I'm going to defer my diet to the future. But, you know, what a more appropriate term might be is that I'm postponing my diet, because you know, it's not going to go away. I'm still going to have to deal with it. So I prefer to use the word postpone. So the next time you see a tax deferral strategy, let's call it what it is. It's a postponement because the taxes are going to have to be paid. So let's start by saying what is not a tax deferral. Well, something that's tax-free is not a deferral because you will never pay tax again. So what are the two tax-free investments that we have? Well, first of all, you have your principal residence, which you don't get a deduction when you put the money in, but you'll never pay tax when you sell your house. And the other thing is a tax-free savings account. The same idea, you don't get a deduction when you put the money in, but you never pay tax. So it gets to grow tax deferred. You'll never pay tax on the growth, but you don't pay tax at the end. So that's tax-free. Not what we're talking about right now. What is the other extreme? The other extreme is where you pay tax all the way through. We call these open or non-registered accounts. So just to be clear, here I'm not talking about TFSAs, RRSPs, RRIFs, LIRAs, pension plans. When you have money just in an account that is not registered, it's called an open account, and you end up paying tax every year on any interest, dividends, or capital gains that you've made. So interest is off of like GICs, bonds, money market. You know, you can buy GICs for 5 years and you can even not get the interest paid to you every year, but the tax rules have changed and you have to pay tax every year on that money, whether you get it in your pocket or not. So most people decide they want to get it in their pocket. Then we have dividends from preferred stocks, and they're taxed more efficiently, but you have to pay tax every year on them. But the thing is, they bounce up your income by something called a dividend tax credit. We don't have to get into that now, a little complicated, but it bounces up your income before it decreases it. So it can actually have a negative impact on any, it can make you end up losing some of your benefits, like your old age security. You can hit your threshold earlier, or some other benefits that you would have got. But the bottom line is dividends, you're going to pay tax on that money every single year. And the last thing we want to talk about is capital gains. So if you have capital gains, let's say you're buying and selling stocks. Well, every time you sell a stock, or even if you're in a mutual fund or an ETF and you switch from one to the other, it's considered a sell for tax purposes. Remember, the government wants your money, so in an open account, you're going to pay taxes every year. So what happens is, as you're trying to build your pile, every year the government's got his hands in there trying to grab your money, right? So yeah, they're taking a chunk off every year. So you can see how it's going to be harder to grow your pile if they're taking money every year, and that is from an open or non-registered account. I always say it's like having your investments out in the open that continually get hit by the tax reign. So the taxman takes his cut every year. So let's get on to the next thing, the tax deferral, which we're really talking about today. What is the #1 tax deferral in Canada that most people use? It's called an RRSP, a Registered Retirement Savings Plan, or Registered Savings Plan for short, RRSP. It also includes things like RRIFs, LIFs, LIRAs, even your pension plan. So here's the thing, you didn't pay money in when you put you didn't pay tax when you put the money in. You actually got a tax deduction, which people love. But remember, you've postponed the tax, so when you take the money out, you're going to pay tax, and the tax man is going to be there to take his cut. Yep, he is always there, and believe me, he never forgets. So just to clarify a little bit, there's a little confusion here sometimes with clients that they wonder, have I paid tax on it? Have I not? If you have money going from your work directly into a pension plan or directly into an RRSP, your company hasn't taken the taxes off, okay? So still, when you take the money out, you're going to pay the tax man. The other way is if your employer takes the taxes off and you get it paid into your pocket, then you go to your financial institution and you buy an RRSP, you're going to get a tax form that you can put on your taxes to get a deduction. And that deduction is what people really love, so they're going to end up paying less taxes right then, and then they're going to postpone the tax bill to the future. So RRSP, remember, you're not saving the tax, you're postponing it to the future. So is this good or is it not good? Here's the thing you need to ask yourself. There's 2 questions you need to ask yourself if you're deferring the tax. You need to ask yourself, when will I need the money? When will I be taking it out? And what tax bracket will I be in? So a lot of people think they'll be in a lower tax bracket when they retire. I don't know. I mean, who wants to plan to live off of a lot less money? I don't think that should be your plan. But sometimes people haven't saved enough, and that's the reality. So you may be in a lower tax bracket based on the fact that you're taking out less income. But what a lot of people don't understand or don't think about is, the tax brackets don't necessarily have to stay the same. You need to ask yourself this question: is it possible, just possible, that the government will increase taxes, and so at the same tax level you end up paying more tax? We have an issue where a lot of the baby boomers are retiring, and of course our healthcare costs are already skyrocketing before they get to that age where they use tons of healthcare, and there's less people working. So where are they going to get the taxes to pay this? Is it possible that they start needing to get more money from everybody and they increase the tax rate, so you end up paying more money? So that's the thing. When do I need the money? What tax bracket will I be in? And is it possible the government will increase the tax rates? That's what you need to think about. And even without thinking about tax brackets, because that's a little bit complicated, nobody knows for sure, although we can do some projections to get an idea. Some people feel so strongly about RRSP versus TFSAs. But, whether on paper you've saved or lost $1 along the way by, the thing you have to realize is when you put money in an RRSP, you get a tax deduction. You don't pay so much tax to the government. But what do you do with that money? In the future, you're going to pay the tax bill, and you may end up being a little bit better off, or in most cases you're not. Actually, if you look at it, the government makes more money if you put money in an RRSP, because you save taxes on the seed, the small amount, and you pay taxes on the crop. So they're actually making more tax revenue off an RRSP. But here's an even more important, even if things are exactly the same between an RRSP and a TFSA, here's the question I like to ask. Most people, when they retire, they're going to have less money to live off of. I would say 95 to 98% of the people I work with, because we're just not saving enough money. That's the reality. So here's my big question to you. If you don't think you have enough money to live off of today comfortably, where you need that tax deduction to spend, what makes you think that when you're retired and old and gray, that you're going to be happy to share that lower amount of income with your silent partner here, the tax man? You know, that's a really important question. So could you, if you find this of interest, could you comment below? Let us know what you think about RSPs. Do you think they're great? You think they're not so great? Pension plans? Oh, and by the way, if you could help us out, you know, if you enjoy this content, please subscribe. And when the subscription comes up, there's a bell that is underneath. If you hit the bell, it means that you'll be notified of all of our future videos that we do. And also, if you could leave us a comment, it helps us be able to share. It helps us grow our channel faster, and it helps us be able to share with more people if we can get some more comments and some more dialogue going. So bottom line is, we've kind of talked about the three different areas. We've talked about, first of all, open accounts where you have no protection from the tax man, or no umbrella, if you will, and you pay tax every single year. And then we talked about the second pile of money, which is deferred money, and like the RSP, where it's like you have an umbrella where you're not getting hit by the tax man or the tax rain as you're growing your money, but the minute you do a redemption and you take money out of your RSP, your LIRA, your pension, that's when you're going to get hit with the tax rain, if you will. They're always there. And then the last one is tax-free, and that's great because tax-free, you're never going to see the tax man again. So whether interest rates go up or down, you don't have to worry about taxes going forward. So those are the three buckets. So remember at the beginning I talked to you, what's the biggest omission or little white lie omission, whatever you want to call it, is when you see your statement and you see a RRIF or an RSP or a LIF or a pension plan, any of those things, what it doesn't remind you of is it doesn't remind you of your silent partner that you're going to lose a bunch of that money to taxes in the future. So let's be honest, if you have $1 million account and it's all in RSP, half of that, if you were to redeem it all in 1 year, would go to the government, actually a little more than half. But if you have it all in, say, if you could have it all in tax-free investments, then none of that money would go to the government. So your $1 million account is worth $1 million in the second scenario, but the first scenario, it's worth more like $500,000 or somewhere in between, depending on your tax bracket. So please remember that when you open up your statements, because people, you know, look at the number and they're really impressed until, if you look at the after-tax amount on your tax-deferred amounts, like your pension, your RSP, your old age security, CPP, all of that stuff is taxable at your tax bracket. So between you and me, the only thing we haven't talked about is permanent life insurance. And permanent life insurance is another way to at least defer tax, because money that is growing in your permanent life insurance, I'm not talking about covering basic term insurance costs, I'm talking about either universal life or whole life insurance, especially where the money gets to grow tax-free until you take it out. Now, of course, life insurance, if you die, pays out tax-free, and there's two ways to access it when you're living. Depending on what you choose, it'll either be taxable or not. So we'll talk about that in a future video. Now, life insurance is not for everyone, but I'll tell you, it has been a good thing for me and my family. So when we go back to RSPs, tax deferrals, again, you know, people are very opinionated. It's great, it's not so great. Here's the thing, if you're taking it out in a lower tax bracket, what's some examples that we have where we're taking it out in a lower tax bracket? Let's say you put money in today and a few years from now you have no income for the year. Maybe you're taking a year off sabbatical. Well, we all get a personal exemption of, currently it's around $13,000 in 2020. So you could take $13,000 out of your RSP, and by the end of the year when you do your tax return, you'll net out and you'll pay no tax on that money. Let's say you were on maternity leave for many years and you had no income. Again, might be an idea to not pay taxes. Here's another one that people often forget, and I'm shocked to say I've even seen accountants forget this strategy because they're so programmed to postpone taking money from your RSP that we forget to think about our situation. You see, if you have no income in a year, let's say you retire at 60 and you're only taking your old age security and CPP at 65, why would you not take money out of your RSP when you're in the lowest tax bracket you will ever be in your life? Because if you're taking money from your open account, there's no tax or very little associated with that. You should be taking money from your RSP, your RRIF, your LIRA, and stuff, and if you haven't turned on your pension. So these are some strategies that using a tax deferral may work. For other people, it may not be worth it. If you're a business owner, you probably have more deductions today than you will definitely have in retirement. Is it worth using an RSP? Often it's not. If you're somebody who has a super good pension plan, an RSP probably isn't the best solution for you. So again, you've got to look at your personal situation, speak to your financial advisor. If you'd like to learn how to become a client with us, make sure you check out the link below on how to become a client with us. Julie Kranitz, Wealth Maximization Group, maximizing your wealth to maximize your life.